Mistras Group, ticker MG, beat consensus. I mean, Q2 2026 revenue came in at 193.13 million, beating the 189.66 million estimate.
Yeah, and EPS hit 28 cents, topping the expected 24.
Exactly. They also raised full-year guidance. Revenue is now projected at 740 to 755 million, and adjusted EBITDA at 92 to 95 million.
And the market definitely noticed. The stock surged, roughly 16.6% after hours?
Yeah, pushing past $18.40.
So you get a nearly 17% pop on a top-line revenue increase of just 4.2%. That mismatch is basically the whole story today.
Right, so we need to figure out for you guys listening, is this just a lucky quarter, or has the fundamental engine of this company permanently changed? Because peering under the hood of that 4.2% growth, the revenue sources are radically shifting.
Oh, they're completely restructuring their revenue mix.
Yeah.
Management calls it their Vision 2030 strategy. Like, look at the segment breakdown. Their legacy oil and gas revenue actually dropped 8.2% this quarter.
His clients are deferring maintenance, right?
Exactly. But that historical anchor was totally eclipsed by their strategic growth markets. Infrastructure surged 76.5%.
Wait, I need to pause you there on the infrastructure side, because 76% growth is massive. But what are they actually doing for data centers? Mistras isn't pouring concrete.
No.
My understanding is their core business is non-destructive testing and asset protection.
Right. They are essentially the high-tech safety net. When a massive data center scales up its liquid cooling systems or an LNG facility builds out its pipelines, you just can't afford a single leak or structural flaw.
Oh, wow.
Yeah, so Mistras provides the highly specialized technicians and acoustic emission sensors to test the integrity of those critical structures. And they do it without taking them offline.
So instead of just sending out blue-collar crews to maintain aging oil rigs, they are doing highly specialized lab testing for aerospace components and multi-billion-dollar data centers, which explains why power generation jumped 26.4% and aerospace and defense rose 13.2%.
Exactly. The pricing power there has to be fundamentally different.
It's like a cargo ship swapping out its ballast, just dumping volatile, heavy oil and gas cargo for the smoother, high-margin weight of aerospace lab testing. Does this Q2 report prove that the traditional oil and gas drag is actually a hidden positive?
Like, it shows their diversification strategy is bulletproof.
Right, bulletproof enough to absorb an 8% hit to their legacy business.
Well, it certainly proves resilience. When your historical core business shrinks that much, but your overall top line still grows and you beat expectations, the high-growth segments are no longer just padding.
They're the primary driver.
Exactly. They are the primary driver of profitability now. And that specialized pricing power you mentioned is directly translating to the bottom line. This better revenue mix pushed gross margins up to 29.2%.
Delivering a record Q2 adjusted EBITDA of $25.8 million.
Which puts them at a 13.3% margin.
And just looking through the balance sheet details from the report, they've pulled their debt leverage ratio down to 2.2x. That is the lowest we've seen since 2018.
Which is huge. For a company that relies heavily on deploying capital-intensive technology and specialized labor, getting that heavy debt burden off their neck means serious free cash flow.
Free cash flow to either reinvest or weather an economic storm, but, that storm could still hit. We have to look at the other side of this. Wall Street isn't universally convinced this turnaround is totally frictionless.
No, they definitely aren't.
Like, Sidoti just cut their Q3 estimates down to 38 cents from 42. If this legacy oil and gas business, which is still a massive chunk of their overall revenue, keeps kicking the can down the road on maintenance due to crude volatility.
Yeah.
Isn't this record EBITDA going to get dragged right back down?
Yeah.
It feels premature to call the turnaround a total success if their legacy anchor keeps getting heavier.
The crude volatility is absolutely the wild card here. If oil rig maintenance is deferred indefinitely, that drag continues. But the bull case management laid out relies entirely on their expanding backlogs in aerospace and infrastructure.
Where demand for lab testing is heavily outpacing capacity right now.
Right. They are betting those high-margin backlogs will provide a thick enough buffer to absorb further energy market shocks.
So it's a race between the dying legacy business and the booming new ventures. Make sure you are following the show for your daily earnings coverage so you don't miss these kinds of pivotal structural shifts. Now, before we wrap up, I found a detail buried in the SEC filings that completely changes the context of this massive stock pop.
Oh, you're looking at the institutional moves.
Yeah. GSA Capital Partners quietly accumulated 79,701 shares during Q2. That was worth roughly $1.39 million at the time.
Wow.
And they did it before this earnings release. It makes you wonder, did institutional smart money spot this transition toward data centers and aerospace, sensing the Vision 2030 inflection point well before the retail market caught on?
That's a really good question.
Something for you to think about as we head toward Q3.